Is the AI tech bubble about to burst? That's what a lot of people have questions about. Hey guys, welcome back to the channel. Today we're going to dive into one of the most important topics that investors really look at during unpredictable markets like what we're seeing now. That is dividend stock. So I came across a recent article by Stephen Kress over on Seeking Alpha, the 5 best dividend stocks to hold during uncertain times. And I definitely wanted to cover this article. Puts together 5 stocks that he not only believes it's going to have a significant yield, but have a lot of quality and resistance when it comes to the market, especially if we see this AI bubble really do burst. So let's walk through these themes of the article, exactly highlighting these 5 stocks, what makes them very interesting. And anytime that I see really investing professionals, I love to share their insight and I love to share their work because to me, the more knowledge you have when it comes to breaking down 5 stocks, specifically looking for dividend income, share with you all my thoughts at the end as well. And of course, this is educational purpose only. Make sure you do your own research before you start investing. Now, of course, let's look at the background in the criteria that the author uses. This is where it really makes a big difference. As we're ending 2025, we're getting into 2026. Many investors are looking beyond those capital gains. We are looking for stability and we are looking for income. As investors looking to end the year moving into 2026, the appeal of dividends lies not only in income, but also stability through the uncertain times that we could see with artificial intelligence. He really emphasizes that when we look at the evaluation of dividend stocks, we look beyond the yield, and you have to. If you're an investor that is just chasing dividend yield in the entirety, chances are you're going to put way too much risk in your portfolio. And if the market does pull back, you can get absolutely devastated when it comes to these high yield. Now, the yield alone, and if you're just looking in that, it can be super misleading, which is the reason why he focuses on dividend safety. Can a company and really reliably pay based on the balance sheet on the dividends that they're looking to pay? Supporting grade factors, quantitative ratings. They have a Seeking Alpha quantitative model that they really focus on, and also the quality of the business and the resilience of the cash flow. See, these are companies that are generating a lot of revenue. And looking at this, he highlights the portfolio in these 5 stocks specifically yield a 3.96 dividend, which of course, well above the 1.15 that we see with the S&P 500. Even the Vanguard dividend appreciation at a 1.65, it is ringing in at almost 4%. So in very short, a very solid yield, sustainable, durable is more important than the yield overall. So as we look and thinking of those filters, I want to run through the 5 stocks that he chose, identify each one, and highlight what makes them a strong pick while keeping that risk in mind. Now, the 5 stocks that he breaks into is the VIG, which is that Vanguard Dividend Appreciation ETF we just talked about a minute ago. The VICI, which is the VICI Properties, HSD, which is the hotel, host hotels and resort, HST. And then the THG, the Han Celestial Group, and Kula, KALU, and this is the Kultura Inc. These are the ticker symbols, guys. I'll share them in the video, but I want to break down what each of them are. Now, looking at the VIG, now this is the Vanguard Dividend Appreciation ETF. Although it's technically an ETF rather than a single company, it really has the dividend picks that appeal for most companies and most investors. Picks and chooses companies that have a huge track record and a long track record of increasing dividends, having the quality, having the stability that they're looking. Now, even though ETFs are built dynamically different than individual stocks, still has a place when it comes to building it out. Now, the VICI or the VICI Properties, ticker symbol is VICI, Real Estate Investment Trust. Now, this is getting into REITs. Now, with REITs, guys, you have to do your own research, really looking on exponential real estate growth, gaming, and resorts. The appeal beyond the yield that it offers, exposure to a niche growth segment, and the quantitative ratings show it is a very strong buy using Seeking Alpha's quantitative method. And then the host hotel and resorts, the HST, another REIT, but this focuses on an entirely different sector. This is looking at lodging and hospitality. Instead of going in and looking at the exponential real estate, gaming, and resorts, it is uncertain that it is a very bold pick. But again, the author is choosing this to have and having the evaluation and dividend to support the income that they're generating. Then we look at the Han Celestial Group, THG. This is another one. This is focused on organic and natural food. The big appeal for this, supply and demand and a steady demand for the pantry consumer staples, less sensitive to cycles. And of course, doesn't look like a luxury good, more defensive, has a really strong dividend history, and a very solid growth potential that we see in here. And the Kaltura is the last one, KALU. Might surprise it, but honestly, Kaltura is more of a tech SaaS oriented business, which is video platforms. But looking at diversification, finding really potential outside of those obvious sectors we see, company has both huge growth potential and an income component that it does have. So, of course, like I said, you want to make sure that you do your own research before you're investing in these dividend companies or dividend ETFs. So now that we've covered the picks, let's direct exactly why these were chosen in an uncertain environment, and also what could the caveat be. So when it comes to the dividend really approach, it really makes a big difference because dividends are going to generate cash flow even in a volatile market, even in a market where the stock market might be pulling back. A majority of these blue chip companies, these cash flow heavy companies, will continue to turn and burn dividends. Companies with very strong dividends have a good, stable model, less volatility when it comes to these wild and crazy swings we see with AI. And they focus on stability to avoid the yield traps. The yield isn't looking at 7, 8, 10%. We're talking getting, at 4%, which is good. For example, research from Fidelity points out dividend yields can look appealing. They can often come with an underlying risk, including a falling stock price and a possible dividend cut. You have to remember, if companies are no longer profitable, if they're not making dividends, chances are they could cut back on those dividends or even eliminate it in its entirety to cover up or really cover some of those profits. So keep in mind, the high yield is not enough. If the dividend and if the business fails, the dividend will get cut. Sectors like REITs have additional risk. You have to be really cautious about it. Interest rates make a big difference. Occupancy rates, if these buildings are left unmanned or really unrented, chances are it could see a big, big cash flow issue. And then, of course, the economic cycle really does matter. Even strong companies can be hit by macro events, inflation, recession, that pressure on their earnings. And of course, dividend safety and quality is the key. So a few takeaways for me, guys, looking at this card article. I like the framework. Dividend quality, not just yield. Again, I know so many investors that really do chase the yield and only the yield, and they got burned on the NAV erosion, or they get burned on a couple other things in a very uncertain market. We don't know what it's going to look like when some of these covered calls that have a strong dividend growth that are generating income see a down market. It's going to be interesting. Now, these are the 5 picks that they chosen over on Seeking Alpha, but definitely do your homework. Look at the payout ratio, look at the fee structure, look at their cash flow, the sector risk that they have, and of course, does it fit in your portfolio? You got to look at bigger picture, guys. Are the dividend stocks in there for income, stability, growth? How are you using them? And the answer may affect exactly how you're going to do it, and also having diversification. When we look at ETFs, when you look at REITs, when you look at tech, a couple different things, you want exposure to everything to make sure that you do have that diversification within the portfolio. So looking at your current holdings, you have to ask yourself, how many positions do I hold, and what do I hold that are paying dividends? How safe are those dividends, and what could I put in to have a longer cushion or a deeper cushion when it comes to dividends? So guys, thank you for watching. If you found the breakdown helpful, please hit the like and subscribe button. And really covering dividend investing income strategies as well as wealth generation. Drop a comment. Do you own any of these companies? Do you have them in your portfolio? And what dividend stocks are you looking at that are not inside this portfolio? And as always, guys, all investing does have a risk factor to it. Do your research. If you're not comfortable, talk to a professional. Until next time, stay smart, stay focused, and I'll catch you in the next video.